Hey everyone, welcome back to Corporate Decoder. We're diving into some financial reports today, and let's just say some of these numbers are so wild, they might just make your accountant quit. Before we jump into the numbers, if you appreciate getting straight insights from corporate filings, make sure you're subscribed. We also have a Discord community linked in the description below, so feel free to join. We're looking at a report for the Princeton Adaptive Premium Fund, and it's all about how they managed investors' money over the past year. This report covers from May of last year to April of this year. What's interesting here is how the fund navigated some really choppy waters and whether they steered the ship to safety or just ended up bailing water. First things first, this report concerns two classes of shares, Class A shares and Class I shares. You may hear those terms in the financial investment space. What do they mean? They are basically the same except for slightly different pricing schemes involved. Let's talk about costs. If you had $10,000 invested in Class A shares, it would have cost you about $185. If you had the same amount in Class I shares, that would have cost $161. Does this mean it is worth it to potentially invest in Class I shares rather than A shares because they slightly edge each other out and give you better bang for your bucks? Let's find out how they actually performed last year. And it's 1.57%. So what does this mean? It is worth it to potentially invest in Class I shares rather than A shares because they slightly edge each other out and give you better bang for your bucksot. Let's find out how they actually performed last year. The fund's Class A shares had a return of plus 3.39%. They aimed for both growing and making income by selling put options. Put options on the S&P 500. It sounds complicated, but it is just a way to try to make weekly profit. Now, the fund also invests in safer fixed income securities. Class A shares did a bit better, coming in at plus 4.53%. Again, it looks like Class A shares performed better than Class A shares and could have been a better investment for you. The report mentioned there were some really large spikes in market craziness, namely August of last year, December of last year, and this past April. You are probably wondering what this means for the fund. The fund had to close down some trades as a function of risk management. The important point is that it did have to take some losses in the short term due to market volatility. However, the fund did recover in April, ending at a plus of 0.79%. This section gets into a historical analysis. It includes the Bloomberg US Aggregate Bond Index as well as the S&P 500 index for comparison. As of September of 2022, if you invested $1,000 into the fund, it would be worth $110.40. Following along, investing in the S&P 500, you would be sitting at 1568.1. Keep in mind that this historical analysis does not necessarily predict what will happen in the future. Here it compares the funds to other indexes to see average annual total returns since inception. The fund had a 4.3% annual return since inception versus 4.117 for the bond Bloomberg index and a whopping 89% for the S&P 500. This means that while the bond index performed similarly, the S&P 500 outperformed by a huge margin. It's holding a total of 20 investments. The advisory fee after some discounts is zero. That's obviously a great sign for the fund investors. Portfolio turnover is at 0%. Essentially, the fund isn't really buying or selling very much. It is really holding on to its investments. This reveals that about 2.6% is in money market funds and the remaining 97.4% is in US government and agencies. This asset weighting shows that most of the holdings are indeed in safe and reliable investments. All top 10 holdings are in various US Treasury bills with differing maturity dates, with the majority holding at around 8-11%. Here, the report noted that there were no big changes, which is pretty boring, which is good. It reveals that the fund had no material changes over the past year. Now let's jump into the Class I shares section. How do you know which one to put your money into? Read more to find comparisons. Again, the cost is lower, 1.57% compared to 1.82% of the A share. Class I shares performed better than Class A as they returned 4.53% during the investment period. The rest is the same here, meaning the same volatility and overall market trends impacted it. As of September of 2022, if you invested $1,000 into the fund, it would be worth 11.92. Did the same with the Bloomberg index, it would be worth about 11.1. Following along, investing in the S&P 500, you would be sitting at a 1568.09. Again, the report noted no material change, very stable. The fund also has a code of ethics and conduct with the principal officers, which states that there were no amendments to any provision of the code. It appears the officers involved acted with integrity for the year in question. In 2025, $19,500 was spent on auditing. In 2024, $19,500 was spent as well, so nothing really changed there, and it's great that audits are being done to keep the company in check. This makes the fund seem reliable. In 2025, about $3,900 was spent relating to tax compliance. This is the same for 2024. This makes the fund seem tax compliant. Lastly, the top executives believes that their financial reporting framework is adequate and effective. So what do we make of all this? The Princeton Adaptive Premium Fund seems to be navigating a volatile market reasonably well. Now, the fund's past financials seem stable and growing. They follow ethics and are audited. I believe at this moment the main risk would be the market forces, as there is very little, if any, internal risk at play. Now, taking a step back, while the returns aren't blowing anyone away, especially when compared to the S&P 500, it shows a level-headed approach in an uncertain world, balancing risk with stability. Tafty, alright, that's our breakdown of the Princeton Adaptive Premium Fund's latest report. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.